Hi guys, today I want to answer a question that is, should you raise with equity or convertible debt or convertible loan, the way, whatever way you prefer to call it. So today I want to discuss some of the advantages or disadvantages and myth about convertible loans and give my opinion on that. Keep in mind that this is an opinion from a person who actually used convertible debt. We use it for our company, so I have first-hand experience, and I have to say, like, I got to see what the market, especially at least in Europe and in the Netherlands or the UK, thinks about convertible debt, and I will share that in this video today. So the reason why I'm covering this topic today is because I just read an article from one of my favorite bloggers. She's a girl, part of 500 startups in New York City, and she made an article as an answer to one of the comments she received from one of her readers, and she listed pros and cons of convertible debt. More indulging on the pros than on the pros probably, but overall she was quite positive about the usage of convertible debt for companies that didn't raise before. So for the first capital to get in. While I have to say that I really do not agree with that. So today I want to kind of work through the things she listed and offer my opinion on that. So the first thing that I noticed is that among the advantages that she listed, there were two that really caught my eye. And the first is the immediacy that convertible debt offers. Is it true? It's true that issuing a convertible debt is quick and immediate. Why? Because you do not need the approval of a notary, so you can just issue a contract, and the guy signs a contract, the investor signs a contract, and you get the money in, right? So it's a very, very good way to cash in. And in most cases, at least in the States, they are not part of a round, so they're just issued as the time goes by, right? So you come across an investor who says, okay, I'm interested, and you can just enter as an investor with a convertible debt and you can get the cash in tomorrow, probably, right? So it is true that they're immediate, but it's also very hard to find that one investor that just takes that once leap of faith initially without knowing whether other investors will jump in, and probably knowing very well that your company needs more than what is willing to invest, right? So in my experience, it's very difficult to just issue convertible debt without being part of a round, because anyway there is a very high risk that their money will maybe wasted because you need much more than what they are offering, right? So, and it's something that investors know. So when they're part of a round, then the immediacy is kind of lost, because most investors will not invest unless everybody else commits and you reach your funding goal. So the immediacy is, yeah, it's kind of lost, and it makes less sense than to issue convertible debt. The other key aspect of convertible debt is that it's cheap in terms of legal costs. And this is also true. Why? Because you are issuing a contract that does not need the approval of a notary. So once you have a template and you agree on the terms, like you're just like a capital, the investment that they put in, etc., maybe the maturity, other things, it's good to go, right? There is a security involved, which is the underlying stocks, but you are not issuing the stocks right now, so you save cost on the notary. This is absolutely true, unless you already have shareholders. So it's the company is comprised of more than you and your co-founders, in which case you will probably need the approval of the rest of the shareholders to issue a security, because convertible debt is a security that has implications on the ownership of the company, right? Being an hybrid kind of security, because it converts, you do need their approval, and that can be expensive, because that may need an approval from a certification from a notary, and also loses the immediacy that I mentioned in the previous example. The way convertible debt was presented in this article, and the way it probably is perceived also in the States, is that it's a very, very quick tool to support and facilitate what's the instinctive nature of investors in the States, right? So they just see a company they want to be in, they don't think it through, and this is a very good way to skip all the intermediate steps, like some of your financials, what's the valuation, blah blah blah, lawyers. So it can be like a good way to just to get investors on board if they want to be on board. But my gut feeling says that this is more like a feature of the American culture, and it can be, at least I've experienced differently in Europe. It can be as immediate and as instinctive as in America on online platforms. There are platforms that facilitate fundraising for startups in the form of convertible debt. That can well be a scenario very similar to what you can read about in the States. But when it's offline, my experience says that it's just not as instinctive as it's supposed to be, and therefore is not as quick as maybe it wants the convertible debt can be, and therefore there is no incentive to use it. Now let me add something on top of that article by adding the disadvantages that you can encounter by issuing convertible debt. And the first of all is that, at least in Europe, they are less common. They're getting there, true, but while in the States they started to pick up in 2009, 2010, when Y Combinator introduced them with Paul Graham, right? In Europe, they are coming now, so you may have investors that are not familiar with that, or they're not really comfortable with that. At least that's what I heard a few times. As well as you may have more difficulties in finding legal firms that are able to offer you that. And I have some very good experiences also here in the Netherlands of very renowned legal firms that were not familiar with that. Fortunately, this was not the case for ours because we were lucky, maybe. But I do know that it's not as common as it may be, or as you may expect to be in Europe. And I would add that it's probably even less common outside Europe. The other aspect that is quite important to mention is that convertible debt, it's a type of hybrid security, as I said in another video. And when it converts, it may have some terrible effects and a terrible impact on your cap table as a founder, right? Convertible debt can come with terms like the cap, the discount, the interest rate, blah blah blah. What this all do is kind of making it difficult for you as a founder, but also for investors to know what's going to happen when you're going to raise your next funding round, and that round is going to be priced, meaning that there's going to be a valuation. And at that point, it triggers all the conversion event that is part of any convertible debt, and the convertible debt holders will become shareholders. It may well be the case that investors that stepped in early on, so they took the leap of faith with convertible debt, will get a much larger stake than initially expected, or even large compared to the stake that the new investor is taking at this point with the price round, right? So that can also create like some conflicts, some difficulties when especially VCs or other kind of investors do not feel comfortable with the conversion terms, right? It's true that most investors will tell you that don't matter. If they want to invest in the company, they're going to work around that, but still it can make things slower and get things more complicated, bottom line. And complexity will also determine that the legal costs for the moment where they convert and you're going to have a price round are going to be simply higher. So as much as you skip them maybe initially with the convertible debt agreement, you're now going to kind of pay the consequences if you want. And again, the structure can be so complicated that sometimes even lawyers can have difficulties. So it's something that may give could make feel investors uncomfortable, and you don't want to have that, right? So that could be one of the complications next to the legal costs. Finally, there's another aspect that it was also mentioned in the article that I read. It says that investors that buy into convertible debt may feel detached from the company, and this is also because probably their decision was instinctive, right? So it was quick, and they didn't like sweat their way into the company, right? Because they didn't go through the negotiation. It didn't really maybe have to talk to them that much. This can create like just detachment from the company. Maybe they invested even like a little sum for their budget. So if you are an early stage company, I truly believe that sometimes it's worth waiting to find the right investor that really believes in what you're doing, because you're going to go through a lot of troubles no matter what. Plans hardly work out. Sometimes they go for the worse. In some cases they go for the better, and I mean, this is what we all hope for. But in any case, you're going to need a sparring partner to discuss critical matters with. And as much as you have your co-founders, you also want to have a more informed decision of your angel or group of angels. So maybe sometimes the wait is worth it, right? And this is something that you may well consider for your own company, because in the end of the day, you're going to live with this company for many years to come, probably till exit. Make sure you also like the people you work with. The final part of this video, I want to talk about the myth about convertible debt that is not priced. Convertible debt are not priced, and they skip the problem of negotiating valuation at such an early stage. I'm sorry to say that, but this is bullshit. And there's a very simple reason for that. So convertible debt comes with a cap. If it doesn't, because it's a contract, so you can decide all the terms, but if it doesn't come with a cap, then we're talking about full investors. As simple as that. Why? Because it means that the investors will convert, the investors that are taking the leap of faith today will convert, at the next price round at whatever valuation that investor will pay. So assuming that you have an angel that invested a little sum of money today, and in 2 years' time you raise capital from a VC firm, that investor will convert at the same valuation as the VC firm that has much deeper pockets. This is extremely, how can I say, this doesn't bring any advantage basically to the investor that believed in you in the early days, right? And it's not even your best interest as a founder to do that. So I would really avoid that, and that's why I'm talking about full investors. On the other hand, so if you do have a cap, well, that cap is nothing else that the maximum valuation that those group of investors or that one, whatever it is willing to pay at that point in time for your company, right? Giving you some slack of time to get to the next round. So they're already thinking, okay, what is the maximum valuation I'm willing to pay, right? So you're going to talk about valuation anyway. And what I'm saying is, if they're willing to think about the maximum valuation they're willing to take, why wouldn't you address the topic of what is the minimum valuation you would pay for and do like a price round, right? So I'm not just saying this because it's it's in the interest of our business, because of what we do, but for a simple reason that I don't not understand why people would try to run away from negotiating the valuation with an investor. Negotiation is good. Negotiation is good because it helps you to get the feeling of the other person. If you can negotiate hard with a person and still do business with him, her, then it's a good business relationship. That happens also in the workplace, right? If you can talk with, very openly with your colleagues, then you're a productive team. So I do not really understand why we want to, like, at all costs avoid to discuss about capital and money, because we all are in the end of the day anyway. So I really struggle to understand why you would not do a price round, and the bottom line of my discussion is you're anyway doing that, even with a convertible debt. So just keep that in mind. It's not like a magic wand. It's not that you're gonna forget about valuation or even mention that. It's still gonna be part of the process, and later on it can actually backfire when they're gonna convert at a cap plus the discount, etc., right? So if you want to have a feeling of what it means to have a convertible debt and what it would imply on your cap table, you can use the convertible debt calculator that we made a few months ago, and it's available here in the description of the video, where you can see what it would happen with some of the terms that you're about to negotiate, etc. And also you can see down below, if you scroll down, you can see the most used terms based on the usage of that convertible by other visitors to the same page, right? So it's quite interesting. It was fun for us doing it, and I would say we got like great feedback on that. So I hope this helps you guys. If you have any comment, feel free to share. In this case, I went a little bit more with my opinion, but bottom line, you can choose whatever security you feel the most comfortable with, whatever suits your case. Just keep in mind that, yeah, the truth is that in both cases you're going to have to negotiate, and there are going to be things to talk about with your investors. So just be ready for that. I'll see you in the next video.